Welcome to the Daily Brief, where I'll go over the highlights for the action in the market for Wednesday, November 30th, and then see how things look for Thursday, December 1st. We had a really powerful rally. The market liked what Chairperson Powell said. They're taking that as a pivot. We still have to ask, we'll really only know this in hindsight. Is this the pivot that everybody's been waiting for in 2022? Is the 24th or 25th time the charm? It seems like we've been playing out this scenario over and over and over that inflation has peaked and is starting to come down. And so naturally, the Fed will start to slow down their rate increases, if not stop, and possibly at some point start to see interest rates come down. That's what the market is playing with right now. And they finally saw the Fed chairperson come out and say something that they liked. So that really led to a strong day. So let's talk about what happened. At the open, we were looking kind of negative. And can you blame the market? My goodness, we've been through this scenario 5 or 6 times at least in 2022, only to have it dashed sometimes by an economic report like the CPI or by Chairperson Powell giving a speech in Wyoming. Well, this time he gave a speech and the market really liked it. But before all of that happened, the market was more defensive. We had a flat open and we fell below the daily pivot at 39.57. We ended up going down to S1 at 39.38. As the day went on, though, the speech came out, and a lot of this is attributed to comments, the early weakness comments by Amazon CEO coming out and not having some real friendly things to say. But then when Chairperson Powell took the stand, prices shot up back above the daily pivot, again at 39.57, got up to R1 at 39.77, R2 at 39.96, broke over 4,000 at R3 at 40.36, and then even closed slightly above R4 at 40.75. So a big, powerful up day as far as price is concerned. We did close at the high, and we were up 3.09% on above average volume that did really increase. We've been really seeing the last week and a half or so. Well, last week was a holiday week, and then this week, people were real apprehensive about initiating new positions ahead of this speech. Well, once that happened, they jumped in. The technicals are looking more positive, yes, on a short-term basis from one day to the next, especially where we pretty much overdid it. The market does have a tendency to overreact to things, but our technicals are looking a lot more positive because the inflation and interest rate picture seems to be improving. And that came from the Fed speak that we had. So here's the chart where we had kind of a flat open. The futures were slightly down before the market opened. So we were down below the daily pivot and we kind of just chopped around. We tried to come back up once and hit resistance at the daily pivot, came down and almost made it down to S1. And then we saw a little bit of a recovery. And then this is when the market really started to pay attention to the speech. And we shot back above the daily pivot. We were able to get above R1, R2. We stalled for a little bit at R3 and then shot above that, went above R4 and closed right at the high. All right, so what are some comments that we can make? Yeah, you could say there was a positive reaction to Fed Chair Powell's speech, but will it continue? Will this euphoria that the market saw on one day, mind you, and that's not necessarily a trend, it can mean that things are beginning to shift, but now we have to watch for that. Are we going to continue with this more positive bias? Is this the pivot point that the markets have been waiting for? The S&P on a more positive basis was able to get above and then close above its 200-day simple moving average. And a lot of people use that to make decisions. After the open, this is what I talked about a moment ago. Amazon CEO Andrew Jassy, I don't even know how to say that, made comments that were taken as negative, and that was putting pressure on stocks. But then when Fed Chair Powell came out, that changed. And I'll go over the specific comments that he made on the next slide. The dollar declined and interest rates fell, which gave support to stock prices going higher. On a short-term basis, a lot of our real touchy indicators like the Stoke RSI, the Williams percent R, our moving average studies, the McClellan oscillator, the stochastics, which never did really come off of being extreme, all of those are extreme positive. It doesn't mean we have to stop here. It just means that we might be exhausted. We might go sideways to slightly down. We need to work off some of this overbought condition to help prices actually continue to go higher. On an intermediate term basis, we just have a couple of charts. The CCI based on 14 periods, that's looking a little extreme. And then the BPI, which had been continuing to look extreme, that's still extreme. And I've actually taken that more as a positive. When we were weaker earlier in the week, the BPI was not dropping with prices. So that I saw that as more of a positive divergence. Then our yield curves are still inverted, all the ones that we've been looking at. A sentiment, it did tick up, but we're not extreme positive yet anyway. And the economic reports that came out, we had the mortgage applications index that comes out every week. It was down 0.8%. And what's interesting, this isn't the weekly one. This is the one that we get every month, where refinancing applications, they were down 13%. My goodness. And then the advanced report for international trade came in. It showed a $99 billion deficit. How would you like to deal with that? The last time it was just a mere 91.2 billion. So it actually went up. Advanced retail inventories did decline 0.2%. The last time we had this report, they were down 0.1%. Wholesale inventories were up 0.8%, where last time they were up 0.6%. And then the revised GDP was actually revised up to 2.9%, where the last time when we got the advanced report, it was up 2.6%. The deflator was up a little more than expected, and that's more of an inflation measure. It was at 4.3%, more than the 4.1% that they expected. This is kind of a concern, the Chicago PMI. Now, that's more local to the Midwest and to the Chicago area, but it came in at 37.2. That's very weak. Anytime you get a reading below 50, that's showing that there's a contraction going on economically. And the PMI is the Purchasing Managers Index. The last time that we got this, it was at 45.2. They expected it to come out a little bit better at 47.5. No, it came in at 37.2. That could be a concern for the economics in the Midwest. The job openings did decline from 10.334 down to 10.334 million. The last time we got this, we had 10.687 million. So we're seeing a fewer number of jobs available, but there's still an awful lot of jobs overall. Pending home sales declined 4.6%, not as bad as the 5.2% that they had expected. The last time, this was actually up 8.7%. So our trend is positive and getting stronger, but we're just barely above the ADX. We're at 20 point something right now. So we're going to need to see some more follow through for the trend to get stronger. Our bias is positive with the up day in the last 2, 3, 4, 5, 6 days taken together, which I measure as our momentum. That continues, or that switch from mixed being positive now. So what did Chairperson Powell say? This was the big thing that the market latched onto. And I'll just kind of read through this and give some commentary as I go. Monetary policy affects the economy and inflation with uncertain lags. A lot of the rate increases that the Fed has already done haven't even worked their way into the economy yet. So we don't know what that's going to do down the road. This can take months, even a year or longer, for this to be felt all the way through the economy. There's so many complications in the economy. There's so many variables that to have this work its way through can take some time. And that's what he's talking about here. And the full effects of our rapid tightening, because the Fed's just been going to the moon as far as how fast they've been raising interest rates. And he says that a lot of these haven't really been felt yet in the economy. So it makes sense to moderate the pace of our rate increases. Ooh, the market loved that. As we approach the level of restraint, that's more like the terminal rate, where this is where we're going to top out and not raise them anymore. make sure that that level will be sufficient to bring inflation down. The time for moderating the pace of rate increases may come as soon as the December meeting. And oh boy, the market liked that. So that's really what gave some support to prices going up. Now, not to rain on the parade here, but this is the model that a large part of the price movement in 2022 has been following. We have the run up with the green line in 2006 through 2008. If we continue to follow that, we might see some weakness coming into the market as we head into the end of the year. We could break this. There's nothing to say that we have to stick with this, but we might follow it at the same time. So just something to be aware of. Also, the VIX. We've been tending to follow a basic shifted pattern because they shifted it ahead 12 days, where when the VIX really goes up, that means that stocks are going down. So could that end up happening between now and the end of the year? Another thing that's more positive is the Investors Intelligence bull-bear ratio. This is another sentiment indicator. Are you bullish or bearish on the market? Well, we had been given a pretty extreme negative reading, and then we're starting to come up out of that now. And this would suggest, because when it gives an extreme reading, we use it as a contrary indicator. Everybody's thinking, oh no, stocks are never going to go up ever again. I better sell now, sell now. Well, that's when we start looking to buy. So this indicator is suggesting that we have some more room to go to the upside. Now, looking at from Tuesday to Wednesday, yeah, we overdid it on a price basis. This is just a one-day rate of change where we showed a big upward move. And the advanced decline ratio was also pretty extreme. So it'll need to work that off. That might slow things down, at least in the short term. Our ADX, after just dropping below 20, is now barely above 20 now at 20.04. So I'm kind of going with the, until I see this go up more, I'm still between the trendless and trending environment currently. But the green line's on top and showed a lot of strength. The red line is really coming down. Now, as long as we don't just totally tank from here, this is probably going to continue to go up. And these lines will continue to be far apart, giving the ADX the ability to climb and stay above the moving average, which shows a strengthening trend. One thing that was kind of interesting, and I don't know if this is an anomaly or what, but on this really powerful update, we saw a real spike in the equity put call ratio. A lot of people were loading up on puts. Maybe it was before the speech because, you know, it's not like Chairperson Powell has been the friend to every party this year. He's given some speeches that have really caused a lot of damage to the markets, and maybe they loaded up on the puts ahead of his speech just to be safe, thinking that he was going to come out and really rain on the parade again. But we did see a real spike up in the one-day equity put call ratio. 5 days, we're still very high, but we are starting to come down. And so we're starting to think, can we work off of this spike as this continues to fall? Because oftentimes when this spikes and then falls, that gives support to prices for the S&P 500. But we've had this happen many times throughout 2022, only to see it fizzle out fairly quickly. Will it be different this time? All right, here's our daily chart. Looking much better, where we got above the 200-day moving average, closed above that. We're able to get above this longer-term resistance and close above that. We still have this trend line up here that we would like to break through to have things look even more positive. We could come back down, but we were down around this pivot level before Wednesday's session, and the ability to get back above that is quite positive. And then down at the bottom, you can see where volume really picked up. Here's our moving average tree showing how we finally were able to close above the 200-day simple moving average. What I'm going to be watching for is, can we stay above this, number one? And number two, after Friday's session, can we stay above the 50-week or the 40-week moving average? Just because that pretty much equates to the 200-day moving average here. That would make things look a lot better, and that would help our long-term trend really hold up. This is another concern, though. The new highs, new lows, they improved and they were up, but they're not really breaking out, at least yet. So on our 5-period simple moving average is still declining, and we're flat pretty much with our 10-day moving average. This is more positive, where we're still going higher with the summation index based on price. We were starting to come down based on volume, but now we've turned back up. Fib levels, where we were in no man's land yesterday, well, we shot up into another no man's land now. We got above this 61.8% retracement level, and then we have a full retracement still ahead of where we're at right now at the 41.26 level, so that could provide overhead resistance. Longer term, we were able to get back above this double Fibonacci level here. No, that's not a double one, that's down here. But the fact that we were slightly above it, came back down, and then closed above it, that could be positive as well. If we start to fall, can we maintain this level at about 40.20? That's kind of significant support right now. Then here's the weekly chart. This is what I'm going to be watching for. Can this weekly bar stay above this 40-period moving average? That would really help things to improve. Then bonds. We had come down to the COVID low, broke through that. We're coming back up. This had been acting as resistance. We were able to see bonds show some improvement in Wednesday's session. And that's what's going to help the market. If we see bond prices going up, which means interest rates going down, and stock prices going up, so you have bonds and stocks moving more in tandem with each other, that would produce a more healthy environment. So what's our outlook for Thursday? The technicals are positive. They never really switched over to negative. There were areas of weakness and there were things that were weakening, but with the up day that we had in Wednesday's session, that shifted everything to being more positive now. So they're positive and strengthening, but in the short term, we are overbought. We probably overdid it with an over 3% move. And a couple of our charts are showing that we're intermediate term overbought, but not a lot of them. And we have to ask this question: has the Fed pivot? There we go. The Fed pivot finally happened after waiting and waiting and waiting for 2022, thinking that this was going to happen. Is this finally what the markets have been waiting for? Unfortunately, we'll only really know this in hindsight, but we have to try to make a stand now to be more proactive with what's going on in the market. So it does look like right now that pivot has happened. Now, there are other things that could happen. There's lots of other things. I have a whole list of geopolitical events. Any one of those could come flying into the markets and have a real negative impact. So we can't just say, yeah, we're going straight up from here, baby. We still have to be diligent. We have to be respectful of what is happening. So our economic reports on Thursday are the weekly jobless claims and personal income and spending. That's a biggie, as well as the PCE price index. That's a biggie. ISM manufacturing, that's a biggie. And construction spending, not so much a biggie, and that comes out later in the day. But then all these geopolitical events. We still have all these lockdowns and protests and things going on in China, which, again, that may be over there, but there's so many companies that do a lot of business in China that will affect not only those companies, but the supply chain, because the U.S. buys so many things now from China. If that gets bogged down, what's that going to do to the U.S. economy? But for right now, the inflation and interest rate picture does look a little better because of the Fed speak. And then at the very bottom, it might be hard to see. Maybe I should have chose a different color. The looming railroad strike, I understand that something has passed the House that is supposed to alleviate or fix that strike from actually happening. Now we'll see if it can get through the Senate and if that strike can be stopped, for right now anyway. So that could be potentially positive, but we want to keep an eye on that as well. So our scenarios, not going with the down scenario, unless you think that we're short-term overbought, but that's more trading. That would be very short-term for right now. We need to see a lot more confirmation for the scenario and the trend to turn down or negative. Going slightly with the up scenario, just because the technicals are positive, but we're a little bit short-term overbought now. Our scenarios did show some improvement, but not breakout improvement. The sector rotation, a little bit of improvement, but not necessarily breaking out yet. Our positive setups, they're still hanging in there for right now and showed some improvement in Wednesday's session. The technicals are still looking positive overall. We're regaining some moving averages and pivot points and fib retracements. Now we have to see if we do continue to go up, are we going to hit levels of resistance and then come back down from there? And I'm kind of also going still with the sideways because we're just barely above 20 with the ADX, but it is getting stronger. We're just barely above 20 and we are positive with the green line on top. So our conclusion, the S&P is positive and getting stronger, but in the short-term basis, we're positive, but could be considered overbought. Intermediate term, slightly overbought, yet still positive. Long term, we're still negative overall until the 50 crosses above the 200. That's when the longer term trend turns back to positive. We haven't done that yet. We've just been able to get back above the 200 for right now. We are showing some improvement and we might eventually get there, but it's going to take some time for this long-term trend to turn back positive. So thank you. Have a wonderful Thursday. I hope you found this helpful. And I hope that whatever you wanted to have happen in the market is what is happening. And I will talk to you in the next video.